Greetings, millionaires, multimillionaires, and future millionaires. I'm Lane Beene, a 28-year retired lieutenant colonel, a former F-16 pilot, and successful real estate investor. During the past 15 years, I side-hustled one single-family house into a multi-million-dollar apartment portfolio with close to 700 units and awards along the way that included Fort Worth Property of the Year and National Multifamily Housing Council Renovation of the Year. I achieved this while working full-time for the Air Force, deploying 5 times to the Middle East, and being a dedicated family man. My goal is to share what I learned to help you become a better investor and level up your millionaire status. In today's podcast, we're going to focus on the key elements of building real estate wealth, tax strategy. The 2 pillars of this wealth creation are 1, effectively place capital or your money in cash-producing assets that increase in value. And number 2, the focus of today's podcast is stage capital or stage your money in tax-advantaged transactions. So we're going to discuss the 1031 like-kind exchange and talk about how to stage your real estate holdings to capture the maximum benefits. But I also want to tell you that I'm not a CPA or an attorney. And what I'm talking about today is to help expose you and introduce you to some of these critical elements of building wealth. I've done a 1031 exchange twice, and so I can speak from experience on the advantages and the challenges with this. But we're using this today for educational purposes, and I want to ensure that you reach out to your CPA, your financial advisor, or attorney to make sure that your tax situation and your real estate holdings are done correctly. All right, today's 1031, I'm going to divide this discussion into 4 sections. What is a 1031 and how is it beneficial? How do I plan to do a 1031 exchange? How do I execute that correctly? And then how do I document it so I can get full advantage? So strap on your flight helmet, warm up your engines, and let's get ready for takeoff. Number 1, what is a 1031 like-kind exchange? Well, the nature of it is it's the IRS Code Section 1031, and that is the provisions that define the exchange transactions, and then they specify how to defer your taxes for a like-kind property. And that property is property that is used in trade or business or used for investments. The code says that none of the realized gains or losses will be recognized at the time of the exchange or the sale. The 1031, so therefore the 1031 is a tax deferral technique, not a tax-free transaction. And it allows the investors or owners to defer or put off your taxes on as many assets as possible for as long as possible. So that was kind of a mouthful there of what a 1031 exchange is. Let's talk about why it's important and why I think you need to be exposed to this to use this into your strategies to build real estate wealth. Here's an illustration that'll show you what I'm talking about. I purchase a rental property for $150,000 and hold the property for 5 years. At the end of that time, I sell the property for $250,000 and I generate a $100,000 capital gain. That's about a 14% year over year for 5-year holding period. And what you would do for tax implication in a conventional transaction is that $100,000 of capital gains would incur a $20,000 in capital taxes, making 100 minus 20, $80,000 available for reinvestment. If the investor utilizes a 1031 exchange, the $20,000 of gains that would have been paid is deferred, and now $100,000 is available for reinvestment into the next project. If this process of 1031 is completed 2 additional cycles, and let's just assume the same 14% return on investment is achieved, then the 1031 investor is able to place more of their capital back into the next second property and third property. And as a result of more capital being invested, they return at the end of those 3 periods $289,000 versus the $185,000, or a difference of $104,000 over 3 cycles of that exchange. So you can see the compounding effect of putting more money into your investment. Deferring taxes is of great value to you. Moreover, the deferred of the tax, or the deferral of the tax, allows the investor to depreciate or take advantage of the time value of money. To illustrate this point, okay, $1 today will buy you 1 bottle of water, but several years ago, $1 would buy you more bottles of water, maybe 2, maybe 3 bottles of water. But the time value of money allows the money to be, or the value to be, eroded, and that is essentially a tax-free loan from the U.S. government. So one, you get to defer the period that you pay taxes, and then by deferring that, the value of that money is eroded out. So that's the benefits of a 1031 exchange, and that's what a 1031 exchange is. So how do you plan a 1031 exchange correctly? Well, the planning part of it is absolutely critical to executing this successfully. And if it's not planned intentionally, it's just not going to happen. This is not a do-it-yourself process for an amateur real estate investor. You need to reach out to a professional that's experienced, has a good reputation in this area, and is trustworthy. And those are qualified intermediaries required by the IRS. Reach out to those, contact your mortgage broker, your agents, and ask for their referrals to make sure you're getting a professional QI is the term for that. How do you plan a 1031 to ensure you have a qualified exchange? Well, first off, what assets qualify? Real property to real property is a pretty safe harbor to assume that that is a qualifying event. The asset classes inside of real property are multiple ones like housing, industrial, retail, commercial. All of these asset classes fall underneath real property, and they can be exchanged in a like-kind exchange. You can invest, or you can exchange single-family property for multifamily. You can exchange storage facilities for single family, and vice versa. Those are all real property to real property. But let me make one caveat. This is not for flippers, wholesalers, or brokers. And what I mean by that is if you buy a property with the intent to resell it, then that does not qualify. If a broker buys the property and resells it, that is not 1031 qualifying factors. Nor is a second, third, or vacation home meet the qualifications in the IRS code. And finally, personal property doesn't qualify. If I have Google stocks or I have farm equipment, selling that for capital gains cannot be exchanged for real property. Moreover, for qualifying real property to real property, it is important to understand the value relationship. In other words, I need to exchange something of similar or greater value so I can take full advantage of the taxes. A $1 million multifamily property for a $2 million will probably not generate capital gains tax liabilities. But if you step down in value or step down in amount, oftentimes you will have to pay some type of tax implication that's called boot. And that's why it's important that you check your information with your CPA and attorney to make sure that that is correct. Okay, plan your 1031 exchange. A very important part is the 1031 exchange schedule. The IRS code is very clear on this point, and it defines 2 very specific milestones. The very first, and let me say, these milestones are derived off of the sale date of the relinquished property. The very first date that's important to identify is the identifying the new property that you will purchase. From 45 days after the sale of the relinquished property, you need to have identified up to 3 different properties. Not that you have to close on all 3, but one of those is necessary to qualify for the 1031. Within 180 days of the sale of the relinquished property, you must close on the identified property to qualify by the schedule. So that's a very tight timeline and important for successful execution. The last thing to plan a 1031 is how you're going to own the property. In other words, you can own an existing single-family property as an individual, as a limited liability company, or through a syndication, or through other methods like tenant in common. Those are all acceptable. The important point to note is you have to own the new property underneath the same business structure as the existing property. That generally doesn't become a problem if you're an individual or you have an individual entity like an LLC, or maybe you're a tenant in common. But it can often hinder the correct 1031 if you're involved in a syndication. So what do I mean by that? Let's say you had 5 partners involved in the ownership of a multifamily project that you wanted to sell and 1031 into a larger multifamily project. But of those 5 partners, only 3 of the partners wanted to 1031 into the next project. The other 2 partners wanted to take their money and invest other places. Well, you would have to invest with the same entity, and those partners obviously don't want to be a part of that entity. So a potential solution that is commonly done is the 5 partners could reach an agreement where the other 2 partners were bought out, and then you could move correctly or you could move successfully into the next syndication. Again, this is more specific and where your tax attorney or your CPA can really give you some good advice on how that can be done or if it can be done correctly. That was how to plan a 1031. How do we execute it? How do we take those planning steps and execute it so that we can get full benefit? Well, the very first thing is you need to notify all of the associated partners or parties. So you need to make sure you notify your agent if you're working with one. You need to notify your lender if that's going to be applicable, and you need to notify other associated members so that they can take the correct action to ensure their steps are accomplished. You need to select a qualified intermediary. We've talked about how to identify that and start working with them immediately and giving them details and documents that they will need to make sure you're on your timeline and schedule for the IRS, and also that the forms are filed correctly for IRS tracking. To execute a 1031, I advise strongly, and when I did a 1031 exchange of a single-family property into a multifamily property several years ago, I had already lined up or in my mind envisioned the sale date of one property based on the market, based on other factors, and I derived that, or I basically back into that timing of the sale of the relinquished property to the acquisition of my multifamily property. I knew what days I would be able to close that, and then I just reversed that to establish the time I wanted to market my single-family property with enough gap or enough margin so that I could correctly acquire the next property and meet those timeline requirements. So to execute this correctly, I advise you to start looking for the new property at or about the same time that you're considering the calendar date and the schedule to sell the existing property, because 45 days and 180 days happens very quickly, and it's sometimes hard to place those together if they're not well planned or executed. Okay, that comes up to the sale of the relinquished property. There's nothing really significant there that was different than a conventional sale, with one exception, and that is how the funds are handled. So that you need to ensure that you're working and establish your qualified advisor, and that the funds from closing go directly to your QI, or they're held correctly so that they don't come in contact with your bank account or they don't come in contact with you. If they do, then that's going to disqualify the exchange and it will become a taxable event. So make sure that you are very careful about where the funds are sent or wired to so that it doesn't disqualify you in the execution of your 1031. So now we've got one property closed, we've got the funds in the correct spot, and now it's a matter of following our schedule to identify, to do your due diligence, to do all of the things that are part of normal property acquisition, and then get that property closed or that asset closed on time. And again, that time is 180 days. That's how to execute it correctly. And then the final step of today's, or the final portion of today's discussion, is how to document this right so that the IRS tracks it correctly. The QI, or qualified intermediary, will be able to provide you with all of that, keep you on schedule, and give you the correct forms. And then once you close that property at the end of the tax year, as you file your tax return, you'll include in that a Form 1065, which your tax accountant and your legal advisor will be able to provide for you to make sure that you show that capital gain from the sale of your relinquished assets has been 1031 exchanged into your new asset. And then the new asset ownership, if you're not part of that group, needs to make sure that your federal EIN number and your K-1 report or property report is filed accurately based on the relinquished property status. So documentation obviously is very important so that you don't get an unexpected surprise with your tax audit. Okay, that's the 1031 process. My intent today was to expose you to this idea so that you could research it more and determine if it was valuable, or determine if it's a valuable part of your wealth strategy. If you determine that it is, and I strongly suggest and am a strong proponent of this idea, is that you meet with your agent, you meet with your broker, you meet with your lender prior to that, and you certainly bring in qualified CPA, accountants, and legal so that you can ensure this is done correctly. But with that exposure, you'll be able to build more wealth sooner, reach your financial goals, and become a more successful real estate investor and more successful millionaire. I appreciate you listening today. My name is Lane Beene. Please reach out to me anytime to exchange ideas on 1031, tax strategy, or real estate tactics. You can reach me at lane.beene@pilot-legacy.com, and let me spell that for you, LANE_BEENE @pilot-legacy.com. Thank you.